Jill Carey Hall, Bank of America Securities U.S. equity strategist, joining us now. Jill, is it as simple as buy banks, sell tech?
Well, we would agree with buy banks. So financials is one of our preferred overweight sectors right now. We like it both in large caps as well as in small caps. So that's a sector that, you know, the higher rates, steeper yield curve, the rotation into value, the pickup in the economy, all of these things are positive for financials. You know, for tech, we were equal weight the sector. I think from thinking about what's going on, if we do expect a rotation out of some of the favored growth areas of the market and into some of the more cyclical value areas, you know, this will benefit some of the other sectors, you know, like energy and industrials, et cetera, more so than the tech sector. And certainly there could be some longer term headwinds to tech from regulation, you know, anti-monopolistic sentiment, some of these forces. So pros and cons there, but certainly financials is one of our top sectors right now.
So clearly you like cyclicals within the large cap space, Jill. How do you feel about small caps right now? We saw Mike Wilson over at Morgan Stanley downgrading small caps earlier this week, given how far they've run and extended valuations at this point. Why don't you agree with him?
So we got positive on small caps back in the fall, and you know, we've seen a really great run in small caps so far, but you know, we don't think it's over yet. And I think from a number of perspectives, when you think about what's going on within the overall market, we're less positive on the S&P 500 and large cap equities, where, you know, if you look at the GDP growth we're expecting for this year, 6.5%, small caps are more similar to the makeup of the US economy than large caps are. They're more domestic, their earnings are more levered to US growth. They're closer to the makeup of GDP in terms of services spending, where there's a lot of pent up demand. And small caps should benefit more if we see a CapEx cycle in the US, which we're expecting, which could be not only the cyclical rebound, but if we see an infrastructure bill or if we continue to see a reshoring of US manufacturing, which we expect. So a number of kind of positive signs for small caps there, even though both large and small caps are trading at premiums to their historical valuations, you're still seeing small caps trade at a historical discount to large caps. So, you know, I think there's more room for positioning and valuations to normalize there. The inflows that we've seen into small caps also aren't, you know, quite at the magnitude of the outflows we saw from them over the years prior.
Jill, how high do yields need to get before I can say goodbye to Tina?
So we looked at this, and you know, there's a number of different frameworks will give you different answers, but a lot of them are centered around 3%, which, you know, when you think about long-term annualized returns for the U.S. equity market, that's sort of the level that valuations are pointing to right now as what investors are likely to get on an annualized basis if you have a 10-year long-term time horizon. And when you think about the 10-year Treasury yield right now at around 1.75%, this is now above the dividend yield of the S&P 500. So, you know, equity income is starting to grow less competitive. So while we still favor equities over bonds, I think that asset allocation decision, you're starting to get closer to a point when, you know, investors can receive a higher risk-free return from bonds than for equities. So within the market, you definitely want to tilt toward more cyclical rate beneficiary areas.
Well, Jill, and that brings me to, you have a 3,800 target on the S&P for year end. That's about 150 basis points or points below where we are right now. What's the downside catalyst? Is it yields?
So I think when we look at last year, we saw a lot of multiple expansion within the market. So sort of anticipating the 20%-ish earnings growth that we're calling for this year. And, you know, now we're seeing more signs of euphoric equity sentiment in the market in terms of, you know, equity allocations are continuing to inch up. We're seeing companies that surprised to the upside this past earnings season did not outperform, which last time we saw that happen was around March of 2000. So, you know, I think this year is going to be more about playing those rotations within the market than just buying U.S. equities overall. And we do like value over growth. So if you see that rotation, that can actually point to downside risk for the S&P 500, given the market cap is tilted towards some of those big mega cap growth stocks.